Hello and welcome to the investment review for July 2013, looking back at the events of last month. Just recently, we've had to face a time when the markets are showing their ability to flex their muscles and test the staying power of an investor. The past month has seen a fall in the FTSE 100 of around 12% after reaching its 13-year high of 6,875 points in late May, which those of you that have been keeping a close watch on your investments for the past month will have noticed in your valuations. As we've said on many repeated occasions, markets are sensitive to news and react to both good and bad news very quickly. Reports of the recent outline for the plans to begin gradually withdrawing QE, quantitative easing, in the United States in 2014, and growing concerns over slowing growth and liquidity issues in China have fueled some negative reactions and are just two examples of how news can affect the markets. So let's have a look at these two areas in a little more depth. Turning our attention to the United States, the content of the statement from Ben Bernanke, who's the chairman of the Federal Reserve, that sparked the market reaction has received varied interpretations from numerous analysts. The message from the US Federal Reserve is that there is no immediate intention to change QE or raise interest rates. The statement was actually based on positive forecasts for the United States economic recovery, which, if they are correct, could lead the bank to be in a position to end its asset purchase scheme next summer, with a winding down process starting this year. QE will continue and unemployment figures fall to about 6.5%, and with the objective of maintaining low interest rates to encourage economic growth. Meanwhile, in China, the central bank has withdrawn its flow of cheap money to its banks in an effort to force the country's banks to be more disciplined in their lending. This action triggered a rise in interest rates as banks lending to each other are now assessing those risks and charging higher rates as a result. Rising interest rates and concerns about economic growth resulted in an immediate fall in the stock market, but this then largely recovered by the end of that day. For the time being, I believe we can expect to see this continuing level of volatility in the markets. Investors who have been forced to buy into equity markets in order to seek higher returns for their money, which may be outside their normal risk tolerance, will be those most likely to react to the noise in the news by selling off their investments and thus actually contributing to the falls in prices. This is therefore another of those times when we would say not to panic, to stay invested and accept this ride. The graph later on in this presentation will explain why. Some of you, like me, will be invested in the JP Morgan Natural Resources Fund, and I believe it's appropriate at this stage to make some comment on this particular fund, which has shown poor investment returns over the past couple of years. This high-risk fund is suitable for adding diversity to some of our portfolios, providing exposure to the global natural resources sector, but in the main it forms only a small percentage of overall holdings. The demand for resources from emerging market countries may have softened during the global economic crisis, but as these emerging markets begin to show a more sustainable and measured rate of economic growth in the future, the demand for commodities will be likely to resume. The fund manager outlook in May 2013 for this fund states, "After 2 difficult years, we believe the sector is poised for recovery. The rebound in global growth has already brought an end to the destocking cycle of many commodities, and we expect this to continue as industrial production accelerates." This is clearly not a good time to sell, but it's perhaps a good time to consider buying. Very briefly, I'd like to talk about risk and reward. Investors have been educated in recent times to understand that if they are willing to accept some risk, they are more likely to be rewarded as a result over time. Building diversity into a portfolio is one of the ways of smoothing out investment risk. There have been many theories about investing and how to achieve the optimum results, much of the theory based on historical data. It is being argued now that a lot of this theory has become outdated as a result of globalization. So although globalization is not a new concept, it has become more noticeable in recent years as the economies of the world have become very much more integrated. The modern era of globalization essentially began with the opening up of the Chinese economy in the late 1970s, and since then other countries have taken steps to follow suit and look outwards to trade. Led by China, the rise of the emerging markets has resulted in an increase in their share of world output to over 50%, and their share in global stock market capitalization is now 15%, which is up from only 5% 20 years ago. As we all know, past performance is not an indication nor guarantee of future performance, and never has this statement been more relevant than it is today. The graph on the following page demonstrates the global returns of different asset classes over the past 5 years, while we've been travelling through the storm of the global economic crisis. We have to think about cash and inflation. The graph demonstrates that cash deposits have not kept pace with inflation, CPI, as we have known for a long time, and investors in global high-yield bonds have been rewarded for their risk. Interestingly, global equities and global fixed interest instruments have ended this 5-year period almost even on returns, although comparing the performance of the two asset classes back in 2009 shows very different results. In summary, the composition of investment portfolios is regularly reviewed in line with market conditions, and as always, rather than make a reactive decision based on short-term news, we aim to achieve a balanced and less volatile investment journey for our clients by taking a longer-term view. My advice remains to stay invested in the carefully selected portfolio of funds that have been tailored to your own particular capacity for investment risk. If, however, we believe that there is a need to make any changes, we will contact you immediately. As always, you are very welcome to contact me or any of the team to discuss your investments or to review your position if your circumstances have changed in any way. Thank you very much for listening. Our contact details follow on the next page.